Hi, everybody, and welcome back to Chapter 23. And here we're going to take a look at relevant costs for managerial decisions. And we'll describe the use of how we use this for short-term decisions and determine the price of services using time and material pricing. And then we'll look at how we do make and buy decisions, which we have all the time in the real business world, and evaluate the sell or process decisions. That would mean whether we want to sell our product or process it further, determine sales mix, segment elimination decisions, keeping or replacing a product selling price, and evaluating special offer decisions. Quite a bit of pieces to this chapter. Okay, so let's look at the use of relevant costs and benefits for short-term decision making. So in the big picture, we look at defining our decision, identify maybe we have some alternative ways we can go, and then we collect the relevant information we need to make that decision. Emphasis on relevant information. We only care about that information that is applicable to making that decision. Then we select a course of action and analyze and assess our decisions. So we are introducing some new terminology here. Incremental revenues. Those are those additional revenues generated by selecting one action over another. Incremental costs, same kind of thing. Additional costs incurred if the company pursues a certain course of action. And then incremental income, incremental revenues minus incremental costs. And so our rule then is to choose the alternative, naturally, that most increases income. Another terminology, sunk cost, that arises from a past decision and cannot be avoided or changed. Sunk costs are irrelevant, not relevant to current or future decision making. Out-of-pocket costs. Those are costs that require a future outlay of cash. Out-of-pocket costs are relevant. Opportunity costs. That's the potential benefit lost by taking an action over an alternative action. Those costs are relevant. And then avoidable costs can be eliminated by choosing one alternative over another, and those avoidable costs are also relevant. So sunk costs are not relevant, and as she's saying, I must consider out-of-pocket and opportunity costs and avoidable costs. Okay, let's look at a make or buy decision. And here, Fast Track is currently buying a key part for $120 per unit. And the cost to make it is $1.05. And it includes direct materials, direct labor, and incremental overhead. So here we're talking about 35 cents for direct materials, 50 cents for direct labor, and some incremental overhead of 20 cents. So the cost to make this little beauty is $1.05, but if we buy it on the outside, it's $1.20. So clearly we're going to make this in-house, assuming we have capacity, because we're going to save 15 cents a unit. So if we evaluate or evaluate the sale or process decisions, here the company needs to decide whether to sell partially completed products as is, or process them further into another product. This kind of decision usually occurs when we maybe make a mistake in processing it the first time, and we have a discrepant product, and we have to say, hey, is it worth it to spend the money to make that discrepant product good product or not. So the decision depends on the costs and revenues of processing it further. The company is going to select the action that generates the highest income, just like always. So here, we sell it as is, we get 50,000. So that's pretty easy. If we process it further, we got to spend 150,000 that costs us 80,000. We're going to get 150,000 in revenue, I should say, and it costs us 80,000. And that generates income of 70,000. So we're going to process it further and save the $20,000. These $30,000 of previously incurred costs are not relevant. They are sunk costs, not relevant. Okay, we want to select the alternative with the higher income. Should we process it further and earn 20,000 of incremental income? We should. Scrap or rework. Variation of the cell or process is scrap or rework. And often in manufacturing, just as I said previously, we have products that don't pass inspection and are discrepant or defective. We can either scrap the little beauties or rework them. The decision rule, same as always, we're going to select the option with the highest income. So in this example, we have revenue from the scrapped units. We can sell it as is, basically, for $4,000, or rework it and generate $15,000 of revenue, but it costs us $8,000 to do that. But we make $7,000 in income. So clearly the incremental income is $3,000 that we would make from reworking that product. All right, determine sales mix with constrained resources. Here, when a company sells a variety of products, some are likely to be more profitable than others. Management looks for the most profitable sales mix of products. It always seems that we sell our least profitable products the most and our most profitable products the least. Anyway, if our production facilities are limited, producing more of one product usually means producing less of another if we're at capacity. In this case, the management must identify the most profitable combination or sales mix, a new terminology for some of you, of those products. We're going to focus on the contribution margin per unit of the scarce resource. Okay, I'll say that again, just be sure you've got it. We're going to focus on the contribution margin per unit of the scarce resource. Let's see what I mean by that. Here, the company makes and sells 2 models of scooters using the same machines. Pro, I guess Pro uses 1 machine hour per unit, and Max, the name of the other scooter, uses 2 machine hours per unit. We need to determine each product's contribution margin per machine hour. Okay, so our selling price here, $500 for Pro and $750 for Max. We have variable costs and contribution margin per unit. And here, our machine hours, 1 hour for Pro and 2 hours for Max. So the contribution margin per machine hour is better for the Pro than the Max, even though the Max is selling for a higher price and a higher contribution margin per unit. So the decision rule then is to produce the model that yields the highest contribution margin per machine hour until market demand is satisfied. So Pro model has a higher contribution margin. the company should produce as many units of Pro as possible up to the market demand. Now, the company makes and sells two models of scooters using the same machine here. So again, we're going to look, we have unlimited demand. So we're going to take those 2,000 units, that's the most we can sell of Pro, and that's going to give us $150 per unit, or 300,000. And the machine hours we're going to use is 2,000 to do that. We're not going to make any max. $2,000, 2,000 hours is the maximum that machine can be run. So we're going to devote all those machine hours to the production of the most profitable product per the unit of that scarce resource called machine hours. Okay. Now, in this particular case, there's a limited demand, and we can only sell 1,200 units of Pro. So what do? We maximize by selling 1,200 units of Pro at $150 per unit. And the max, we need to figure out how many machine hours we have left, which is 800. So I can convert that into 400 units at $100 per unit. And that total of 220,000 then represents the most profitable mix of those two products. I think when you go through this, you'll have a better idea. This is pretty straightforward, I think. The idea is to use the remaining capacity to produce the next most profitable product. All right, evaluate segment elimination decisions. In this case, this is surprisingly difficult for many managers to grasp. It's really quite simple in my mind. I've done it a million times. And when we're looking to eliminate a segment, it's a candidate for elimination only if its contribution margin is less than its avoidable fixed costs. Avoidable costs are the amounts that are eliminated when the segment is eliminated. Unavoidable costs are the amounts that would remain even if the segment was eliminated. And because we often use allocation methods for fixed costs, this gets very confusing for managers to really understand how this works. That's why they need us. So here is the segment totals before segment elimination. And I've got treadmill and wellness and fitness. And as you see, treadmill is losing money on a I call it fully accounted basis. And what we want to look for though is this 15,000 of fixed costs. It's generating $5,000 of contribution margin. If I make this product go away, this $15,000 would have to be absorbed by these other products. So it should be eliminated only if the income increases from elimination. It should continue if income decreases from elimination, which it does in this case. Okay, this looks like a good place for us to stop this video. And when we return, we'll take a look at segment elimination analysis. Until then, bye for now.